Welcome back to everybody's favorite show, Principles of Finance. Today we're going to dive into the world of dividends and dividend policy. Now, terms you should know is that the dividend payout ratio is equal to the dividends paid per share divided by the earnings per share. Notice this is different than the yield. The yield is the dividend divided by the price of a share of stock. This is divided by the earnings per share. Remember, we calculate that, the EPS. So you can think of that as the dividend on each share divided by the profit on each share. And it gives you an idea of how much of the profits are going back to the owners. And there's a trade-off between giving dividends and future growth. When you're giving dividends, you're paying out cash to the owners. That's a good thing. Now, that means that cash is not available for future growth. So, either we're not going to grow, or we're paying those dividends, and to get the cash for future growth, we're going to have to go to external financing. In other words, sell more stocks and bonds, or bonds. Now, how did dividend policy affect the stock price? Well, there's several views. The first one is it has no effect. I don't think that's really true, but there's probably people who espouse that. Second view, if you have a high dividend, it'll increase the stock price. People believe that if they're getting their cash now, there's less risk on those future cash flows. I'm getting my money now, so I don't have to worry about it in the future. The other view is if a low dividend will increase the stock price. And the reason for that is investors don't have to take income today and declare taxes and pay taxes. They can pay those taxes off in the future as capital gains. So I guess if you put 2 and 3 together, you say, well, some think it'll be better, some think it won't, so therefore it ends up having no effect. I think you find that when businesses change their dividend policy, it does have an effect on the stock price. Now, how do we decide how many dividends to pay? How much in dividends? First theory is if I have nothing better to do with my money, no investments, no future plans, I should give the money back to the owners. Second effect said, and by the way, all of these theories can be true. They all have certain elements that are true. Right? There's no one theory that's better than the other theory. They all have elements, and you can find truth in all of them. Second one says clientele effect. Well, some people want dividends, and they're going to buy stocks that pay dividends. These are people that want regular streams of income. We sometimes call them widows and orphans stocks. You could have pension funds that want regular streams of income. You could see insurance companies that want regular streams of income. They'll buy dividend-paying stocks. Those that don't want that income won't. Then there's the information effect. If I change my dividend policy, am I telling the world something about my business? Well, probably. If I cut my dividend, it means my future growth doesn't look so good. If I'm raising my dividend, it is signaling that I'm probably pretty optimistic about the future. The next one is a little bit more difficult to grasp. Remember we said that early on in the semester that there are agency costs, where there's a conflict of interest between the manager and the owners. Sometimes the manager acts in their own interest and not in the interest of the owners. The thought is, if you pay dividends, then the way the firm has to increase its capital, the way the firm raises money then, is to sell more stock. So if I pay dividends, I don't have the money for new projects. To get money for new projects, I have to sell stock. And if I sell stock, those new investors are going to pay attention and keep an eye on the managers which will help reduce the agency costs. I hope that makes sense. We're worried about the managers not acting in the interest of owners. So if there's new investors coming in, they're going to take a really close look at how those guys are managing. And new owners will come in because the company has to issue stock to raise money. Then there's the expectations theory, that the market reacts as the world changes relative to their expectations. For example, if I thought things were going to be well, and then, oh crap, here comes the coronavirus, that changes my expectations. That changes my expectations both of the dividend and of the stock price. In practice, there's some limitations. And there's a legal limitation. You got to have more assets than liabilities. Basically, the firm can't be underwater and still pay out money. You have to have equity in the firm. You have to have cash. You may have assets, and your assets may be a lot bigger than your liabilities, but it may be stuck in buildings, it may be stuck in plant and equipment, and you may not have the cash. A firm may want to look and say, and how do I think the future is going to be? Is it, is there going to be an oil crisis? Oil prices are down low, but they're certainly going to go up. How's that going to affect my business? I may be better hang on to cash if I don't think my cash flow is going to be the same. And dividends. I may want to hang on to dividends so I don't have to sell more stock to raise money. Remember I said a minute ago, if you pay dividends, you don't have that cash for new projects. So how do you get new projects started? Well, you got to sell more stock. If I sell more stock, then there's more owners in the business. So a business may want to maintain control by not having new owners, and so it's going to retain those earnings rather than giving them as dividends and then having to go out and sell more stock.